Hello everyone, this is Professor Raghavendra Adhyapak, KLS Kokte College of Commerce, Belagavi. So in the last class we studied about the definition of the bonds, and what is the meaning of fixed income securities, correct? So what is a fixed income securities? Fixed income securities are the securities which provides a fixed rate of return on its investment, correct? So in that we studied about the bonds. Okay, so in today's class we are going to see about the what are the features of bond. Okay, so in that first one is credit instrument. So what is that? A bond is a credit instrument. So a bond is also a type of loan where the bondholder is a creditor to the company and he is entitled to receive the payments of interest and principal, correct? So for example, what will happen in the case of loan? If you taken loan from someone else, right? So then that person will become a creditor to you. So in the case of bond also, you have taken the loan from the outsiders. Instead of that, you giving a one certificate of that bond, correct? So this is also what a credit instrument where the issuer has the obligation to pay the interest as well as principal amount at the end of the maturity and periodically interest, correct? Next is interest rate. So what will happen in case of interest rate? Every bond holders must and should get a some fixed rate of interest on their investment. It may be 9%, 8%, 7%, 12%. So that percentage will differ from different bonds, but every bondholders get their interest rate on their investment. Next is maturity date. So in the maximum of the cases, each and every bond has its own maturity date. So maturity date will be after 1 year, 2 years, 3 years, right? So what is maturity date? Maturity date is a date at which the that contract between the issuer and the holder, that contract comes to an end and he get his principal amount back. For example, there is a bond of 10,000 rupees which are having the 3 years of maturity period. Okay, so now if that person is purchased bond in 2021, okay, June 2021, so after next 3 years means June 2024, at that time it comes to a maturity. So after that there will be no any obligation between the issuer and holder, and that one who issued, he will return back his principal amount to its holder, correct? So that is the maturity date. Okay, next is priority in liquidation. So already we studied how the liquidation process all take place in the companies. So whenever there is a liquidation is going on in the companies, correct, at that time they have to pay the first outsiders, right? Outsiders payment we called, correct? So like that, while payment at the time of liquidation, even the bondholders are considered as outsiders and they will be given first preference while payment in the case of liquidation. Okay, next is less volatile. So volatile is nothing but fluctuation or changes, correct? So when we purchase the bonds, the interest rate whatever we get on that, that will be almost fixed. Okay, there will be no changes. Even though there may are changes, that is very slight or a small changes will be there. There is no any huge fluctuation in the rate of interest. For example, we purchased a bond of 10% interest rate, means next 5 years or 3 years till the maturity we get that fixed amount of interest, correct? But the same we will not see in the case of equities. Okay, why will not see in the equities? For example, on equity the company is giving the 12% of dividend for this year, but suddenly there is a loss for the next year in the company, then equity shareholders get the return? No, right? So last year 12%, this year suddenly almost 2 or 3%. So there is a what? High fluctuation or huge change, correct? So such kind of fluctuations or changes we cannot say in these bonds. So these bonds are less volatile. We say that this is less volatile. Okay. So these are the features of the bonds. Okay. So next we will see what are the different types of the bond. Okay. There are many types of the bonds. Okay. So when you go through the internet, you will get the many types of the bonds, but for easy understanding purpose we categorized into these five categories, okay, on the basis of its different features. Okay, so in that first one is on the basis of issuer. Okay, so types of bond हम क्या करते हैं on the basis of issuer पे five categories में divide करते हैं. One is by local bodies, means the bonds issued by local bodies. Second one is by banks, by corporates, by public sector units, and financial institutions. So, on the basis of insure, we categorize like this. Next, on the basis of maturity period. Okay, so when it gets matured, on that basis, we categorize it into again three types: short term bonds, medium term bonds, and long term bonds. Okay, next, on the basis of coupon rate, so whatever the interest we get on the bonds, on that basis we again categorized these bonds into three types. One is fixed rate of bonds, fluctuating rate bonds, or floating, we can say that floating rate bonds, and zero coupon rate bonds. Okay, so this is on the basis of coupon rate. Next, on the basis of option. So what is option, that we can see while studying these types in detail, but for a time being there are two types on the basis of option. One is call option bond and another one is put option bond. Okay, so what is call option, what is put option, that all we see in the further classes. Next is others. So apart from that, whatever comes under that all comes in a other. Okay, so what are that? First one is secured bonds, second unsecured bonds, redeemable bonds, irredeemable bonds, tax-free bonds, inflation-linked bonds, junk bonds. Okay, so like that we categorized different bonds as per its issuer, maturity period, coupon rate, like that different category. Okay, so now we will see about these bonds one by one. Okay, so first we will see on the basis of issuer. Okay, so on the basis of issuer, so first one is on the basis of issuer. The name itself says that the bonds are classified on the basis of person who issues, correct? So in that first one is by local bodies. Okay, so what it means, if any bond is issued by the local bodies, then such bonds are known as local body bonds. Okay, for example, local body means what? Municipal. Okay, municipalities will be there. Okay, so they will be issued some bond, municipals, so that bonds are known as municipal bonds, right? So such kind of any local authorities are issuing any bonds, such kind of bonds are known as local body bonds. Next is any bonds which are issued by the banks. Such bonds are known as the bonds of bank, right? So again on the basis of corporates, if any MNCs or corporate companies issue the bonds, so that are corporate bonds, correct? Next is public sector units. So if any public sector companies are issuing the bonds, those are comes under the public sector unit bonds. Next is financial institutions. So apart from this, any other financial institutions are issuing the bonds, so such bonds are known as financial institutions bond. Okay, so these are the different bonds on the basis of issuer. Next is on the basis of other types, we will see one is secured bonds. What is secured bonds? The bond which is secured against the some collateral asset, then it is known as secured bonds. So what is collateral assets and all? For example, the company is issuing a 10,000 rupees bonds. Okay. So for that, what will company says that to against this bond of 10,000 rupees as a security, they will collateral any assets like furniture, building, plant, any other type of assets by which that bond will be secured by it, and even the that bond holder get some confident or some surety regarding their investment. Means what? If the company fails to pay that amount of the bond at that time, the bond holder will have the right to get those collateral assets, right? Such kind of bonds are known as secured bonds. So in simple words, secured bonds are nothing but the bonds which are secured with any asset, collateral assets. So that are known as secured bonds. Okay. Next is unsecured bonds. The bonds which are not secured by the any type of assets collaterally, then it is known as unsecured bonds. Next is redeemable bonds. So what is redeemable bonds? The bonds which are redeemed or which has a specific time of maturity period. Such kind of bonds are known as redeemable bonds. For example, a bond is issued of rupees 1000 for the 5 years. So 5 years is what? Its maturity period. So after the 5 years it get redeemed, right? It will be paid back to its holder. Okay, such kind of bonds are known as redeemable bonds. What is irredeemable bonds? Irredeemable bonds are the bonds which are not having any specific maturity time. Okay, such bonds are known as irredeemable bonds. Next is tax free bonds. So the bonds on which the tax is exempted in the hand of the holder, such kind of bonds are known as tax free bonds. Okay. For example, whenever we do any other investment, at that time you have to pay the certain taxes to the government, correct? So if you purchased any tax free bonds, at that time you will be exempted from the tax. So such kind of bonds are known as tax free bonds. Next is inflation linked bonds. So what is inflation linked bonds? So in the first chapter we studied how inflation affects on the bonds, correct? So to avoid the such negative circumstances or losses which occurred with through the inflation, so to protect the investor, such kind of inflation linked bonds will be issued, and they pay the interest as per that. Okay, so what happen in case of inflation bonds? For example, a 1000 bond of 10% interest rate or coupon rate is issued, okay, for a 1 year. After the 1 year, they get the 10% of interest as well as that principal amount, but there was inflation of 4%, right? So when there is 4% inflation, means all the values of the commodities are increased and the value of money is decreased. So due to that, a adverse effect will be there. Okay, so even though 10% interest is paid, but its actual value in the market is what? Only 6%. Why? Because there is a 4% of inflation. Okay, so due to the inflation, the value of the money is reduced in the market. So to avoid such losses, they linked with the inflation. Means whatever inflation is there, that amount will also added back to the investor and they pay the interest. For example, I said that 4% interest inflation was that, right? So that 4% is also added back to the investors securities. So means what? Instead of getting the 10,000 at the end of the year, he gets the 14%, by which that 4% loss of the inflation will be matched, and that amount will pay to the holders, right? So such kind of bonds are known as inflation linked bonds. Okay, next is junk bonds. So what is junk bonds? Junk bonds are bonds which are highly volatile and highly risk, and they will get the high rate of interest. So junk bond में क्या होता है, interest भी high होता है, interest will also more, the risk will also more. Okay, so such kind of bonds are known as junk bonds. Usually the speculators will invest in such kind of junk bonds, and the for safe investors junk bond is not preferable. ओके, सो यहाँ पे क्या होता है, जंक बॉन्ड में रिस्क भी बहुत ज़्यादा होता है, रेट भी क्या होता है, ज़्यादा होता है, बट ड्यू टू द रिस्क it is not recommendable for the safe investors. Okay, so those who are in the speculation business, they preferably purchased such kind of bonds. Okay, so this is about the two types of the bonds. So remaining parts we will see in the next class.